Okay, good morning, everyone, and welcome to today's Tuesday Markets Outlook webinar. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play, and today I'm going to be giving you my thoughts and analysis on the current market. So before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today, kicking off with the major equity indices, we have seen some pretty interesting movement to start off the week with some bullish price action yesterday. But we'll take a look at where those key levels are and see where price could potentially head towards. From there, we'll be moving on to fixed income and commodities. We'll also take a look at the sector rotational model, highlighting which sectors are outperforming and underperforming the broader market. We'll take a look at a couple of subsectors that I have for you today, and we'll end today's webinar with some bullish and bearish market observations. So starting off here with the S&P 500 using the SPY ETF, what we saw towards the end of last week really was a breakdown below that 420 key level. Now that's a very significant level because it is also the 420, also 23.6 Fibonacci retracement area. And price breaking below that did indicate further downside. However, the next minor support level was at 410. So we have already seen a bit of a bounce yesterday, set to open a little bit higher this morning. However, I'm not looking too much into yesterday's price action. And the reason for that is due to the fundamentals in play this week. Tomorrow, we'll have the Fed meeting and Jerome Powell's speech. And likely we'll get a indication as to where interest rates are heading, where the Fed are currently at, what's their view regarding interest rates and inflation. And also on Friday, we have more jobs data. So from a macro perspective, it's going to be a very macro-heavy week. And that's when technicals become a little bit less important. We have to remember that we are still in a bearish price structure defined by lower highs and lower lows. So we could be forming a new lower low here. And with the next high forming, 420 is a little bit low here, but we could see, a price rally towards 21 and 55-day exponential moving average. We know that that can tend to act as dynamic resistance. And from there, we could be in store for another leg lower or a revisit to 410. But that's looking at charts without any macro lenses. But at the end of the day, the macro lenses are what's going to actually impact future price movement here. So I do expect to see a bounce, yesterday, today, maybe even tomorrow in the morning. But keep an eye out for that Fed announcement as well as jobs data. It could very well dictate price action until the end of the year. So with that in mind, I would say when it comes to positions, you may want to unload some of the bearish positions today before the Fed meeting. We could very well see a big bullish bounce. And maybe sit on your hands a little bit when it comes to trading because, again, it's going to be very volatile this week and quite unpredictable as well. And at the end of the day, the bearish structure still remains. However, what this bullish price action does allow is for better risk to reward bearish entry points across the board. Should this bearish structure continue next week, also we could see another bearish entry point forming because right now the bearish move that we've seen in equities across the board has been a little bit overextended. We can see the 50-period CCI approaching that negative 200 area. So it's not the right time to be putting on bearish positions, not yet anyway. Rather, if you are looking for bearish positions or bearish exposure, wait for a bit of a retracement higher before looking for those bearish entry points. Now for the NASDAQ 100, we did see it bounce from this very minor 340, 341 level. It also did break below a major level of support at 350. So price is still hovering just below that. If we get a breakout back above it, keep an eye on the 21 and 55-day exponential moving averages or even that 360 area. It did act as a minor level in the past. So again, like the S&P, I do expect to see a similar pattern if the bearish trend continues, but we do we are in store for a retracement higher, especially with price actually touching an oversold condition with the 50-year period CCI at -200 and now starting to recover from that. The next key levels of support obviously would be 340, but we also have the major level at around 332. Those will be the two key areas that I am looking at to the downside for the NASDAQ 100 should we see a further decline. Okay, IWM, the Russell 2000 ETF. So we're looking at small caps here. IWM broke below 170. It's always been relatively weaker against the broader market. So breaking below its major support level before the S&P and the NASDAQ wasn't too much of a surprise, but it has already approached the next major level, which is also the 2022 lows at 163. And what we're currently seeing here is a very bullish price action. Price may be a little bit overextended to the downside, but we're not exactly seeing a huge bounce with a big uptick in momentum. Yes, price is set to open a little bit higher this morning, but it's not really enough to justify a bullish view from here. So we could still see that limited retracement higher. We have that 170 level that could potentially act as a major resistance zone. But for IWM, this is looking quite weak. And small caps have been weaker, relatively speaking, against the large cap indices like the S&P and the NASDAQ for quite some time. So I don't expect too much of a bounce here for IWM, even in a more bullish environment. I think if we do get into a more bullish environment in the next week or two, I'd still look for exposure in large cap indices as opposed to IWM. Okay, TLT, the Treasury Bond ETF, clearly reacting to this major support level at 82.50. Now, this is a support level that was initially formed just before the global financial crisis or during the global financial crisis. And we can see here that price is bouncing from that level, but not, again, with significant momentum. So it is respecting support, but there isn't really much reason for it to go to the upside when yields are as elevated as they currently are at. So for now, it could be a potential bullish credit spread where you're playing on the 82 level holding as support. But ideally, what you'd want to see is a short-term rally back towards that 88 zone or so, or even the area between the 21 and 55-day exponential moving average. And from there, look for bearish entry points as well. So another credit spread opportunity, like we've been doing pretty much throughout the entire year. So US dollar, DXY, we have seen a breakout above 105.50, but since then, price has lost out on some momentum, clearly respecting that 105.50 level as a major area of support, but struggling to break above 107. So we are seeing that range-bound market that we discussed over the last few weeks, starting to see it pan out. But again, a more hawkish Fed would indicate a stronger dollar. So just keep that in mind. And tomorrow's Fed meeting could very well be either upside catalyst to break above 107 in the coming days, or a downside catalyst where we could see price break below that 105.50 major support level. Moving on to gold. Gold has now broken above a major level at 184. Now, last week, I did say that given the geopolitical risks at play, that's going to outweigh a lot of these technical levels. And with gold being a safe haven, we have seen it rise pretty astronomically since, just a few weeks ago. It was at this major support level at around 168. Since then, it has broken above multiple resistance zones and now above 184 after initially pulling back slightly. So there's clearly a lot of underlying momentum in gold. You don't want to be short gold, no matter how oversold it gets over the next week or two. Because again, geopolitical risks and macro factors will outweigh the technicals in this case. I do expect to see a continuation higher, targeting that 190 zone, which is a major resistance level. Really, anywhere between 190 and 192 is a strong major multi-year level of resistance that you want to be looking at for potential bearish or shorting positions. But again, gold, tough one to short currently. If anything, we have to wait for a continuation higher. Okay, moving on to oil. So oil, looking at light crude oil futures, what we're seeing here is this level 83, 82 area still holding firm as support. It was a major resistance zone in the past, but for now, price is respecting this level despite a very sharp decline in momentum. So supply cuts are naturally keeping oil prices elevated, but not exactly finding that momentum to continue higher. Look for energy companies' potential short-term bullish entry points if this level of support holds, especially those with high correlation to oil prices. We do have 88 as a clear resistance zone, but of course, the previous swing level, major swing level at 94 would be the next major resistance zone, as you can see on the weekly time frame as well. Taking a look at the sector rotational chart, we have 6 sectors in the improving and leading categories, and we have 5 in the lagging and weakening categories. Sorry, it should be 7 and 4. My apologies. Got to change that. There was some rotation here for industrials and real estate. But either way, in the leading category, we have energy, losing out on that momentum. No surprise there, given that we just spoke about oil that has lost significant amount of momentum in recent weeks. We have communications making a revisit back to the leading category after staying in the weakening category for quite some time. Technology as well on its way back into the leading category. And once technology gets into the leading category, it'll be quite interesting to see how the major indices hold up. Given that technology has such a high weighting, we've seen in the last few years, really, that even when technology is the only sector in the leading category, the major indices have continued to rise. The COVID pandemic recovery period being one of them. Discretionary rotating from the weakening into the lagging category. So consumer spending, even though we saw high retail sales numbers come out a couple of weeks ago, investors are not convinced by that. So look out for a weakening discretionary sector. Financials heading towards the lagging category as well, along with materials, but materials and healthcare still well within the improving category. Let's see how this plays out in the next few weeks. We also have real estate rotating up from the improving into the lagging category, and a pretty weak sector, in my opinion. Utilities and staples still finding some momentum. They've been between the lagging and improving category for quite some time. But now with these defensive sectors, given the uncertainty in markets, we are seeing some rotation back into these defensive sectors. So taking a look at the energy sector, which we've really looked at for the last couple of weeks, because price is at a major resistance zone between 92 and 94. It provided us with some good bearish entry points in the last few weeks, but price as well now at this 84 level. Remember, this sector does have a high correlation to oil prices, and oil is sitting at a major support level. So if you did enter a bearish position in the last a few days ago when price was at around 92, or last week, when we had the market outlook, now would be a good time to get out of that position. It is showing some intraday support yesterday from 84. And as we can see, this oil again has found some support. So now would be a good time to get out of the energy sector and, perhaps wait for another move higher before looking for bearish opportunities once again. So semiconductors, this was a subsector of interest last week because we saw some bullish price action at 140, which was a daily support level. However, that didn't quite last. Instead, we have seen a move lower, and this breakdown lower, followed by multiple intraday retests in the last few sessions, indicates that we need to get out of this trade. Unfortunately, it was a good risk to reward at the time, but it has been invalidated. So, and thankfully it hasn't moved that much lower, but it doesn't seem like this is a false breakout, given the fact that we are seeing failed retests here, and now would be an ideal time to get out of the semiconductor sector. I would still keep an eye out for the semiconductor sector. There are minor support levels at around 132, as well as 128. And this could provide some good bullish opportunities in the future, because we are seeing slow and steady rotation back into the technology sector, which obviously semiconductors make a big part of. So semiconductors, unfortunately, yes, it did get in our thesis for the trade got invalidated, but it's still very much in the bullish watch list. Okay, so new idea for today is Walmart. Walmart, looking for a bullish position here because, sorry, a bearish position here because of the fact that Walmart is now at a major resistance zone at 163. We did see some weakness a few weeks ago, but price immediately finding support at that 150 level when it was oversold and is now back at this area. And we are seeing there isn't that much momentum behind it anymore. So this does provide a good risk reward bearish entry point. Maybe wait a day or two if we do get a bit more of a rally. But the risk reward certainly favors the downside, targeting the mid 150, so 154 to 156, that area also. Okay, moving on to C Limited. So C, what we've seen here is this strong bearish trend, a big breakdown below 56, then finding some support at 35. Since then, we've had a slow retracement higher, but again, price struggling to break above and stay above its 55-day exponential moving average at the high 40s, and showing that bearish price action. Yesterday's price action was a little bit bullish, so wait for a continuation higher, maybe as close to 48 as possible. And once we start to see some bearish price action, that will provide a good risk to reward bearish entry point, targeting that 35 level, which is a major daily support zone. So United Health was a name from last week that we were looking at, with prices at around 520, 525. We were targeting 507, which is the next key level to the downside. And it hasn't really worked out that well for us. We're seeing a gap up higher here. Once again at this resistance zone, and it is a major resistance zone if you take a look at the weekly time frame. So it hasn't broken the thesis, but our entry point wasn't optimal. There would be a much better entry point for those that haven't gotten into this position yet. The closer price gets towards that 550 area. But unfortunately for now, we are seeing, the fact that our poor entry points not really perform well, given the fact that we are seeing this gap up higher today. So our IBM trade is still quite an interesting one. For those of you that have joined me for the last really few weeks, we were looking at a long-term bearish IBM play. We were looking at the fact that price is at this 150 zone, which is a major level on the weekly time frame, a multi-year resistance zone, and we saw a strong rejection there. And what I mentioned back then was to essentially break this into a few trades to the downside, assuming our target is around 120. So the first leg of the trade worked out very well. We had a nice retracement, and the second leg of our trade was working out quite well, but we had earnings. Earnings saw a gap up in price back towards 142, but once again struggling to break above it. 2 rejections in the last 2 sessions. And for those of you that didn't manage to enter the second leg, excellent risk reward bearish entry point, targeting maybe the 132 level, followed by another retracement, and finally looking at around that looking for the 120 zone. So a longer term thesis is bearish towards 120, but it's best to break it up into a few trades. For those of you that had already entered the trade, now would be a good time to potentially roll the position to new strikes. Unfortunately, with earnings, that's always a risk, but we are seeing bearish price action at a major resistance zone. So Comcast was a name that didn't work so well for us. This was a bullish play, playing off the 43 level of support, heading into earnings. But unfortunately, earnings did come out, even though we saw an upside surprise. We saw a gap down in price, so forward guidance would have been poor. And since then, price is a little bit oversold, or quite heavily oversold, I should say. And I do expect to see a move up higher. That being said, our thesis has been validated, and this is where you'd want to close out that trade. So difficult week for market observations, unfortunately. But again, with earnings season, this is the risks that are associated with these big moves, either to the upside or the downside, that are very difficult to predict. Okay, AMT. So AMT is a new idea, part of the real estate sector. So what we've seen here for AMT is a very strong move to the downside, price breaking below that 180 major level. And we've had earnings which has saw a rally in price, breaking above its 55-day exponential moving average. What I'm looking for is a continuation of this rally towards 180 or anywhere in this area really, and for some bearish price action for a nice risk reward move lower, especially when you consider that AMT is part of the real estate sector, which is underperforming and is in the lagging category. So this pop-up higher in price thanks to earnings will eventually provide a good bearish entry point. And with that, that is all I have for you today. Thank you so much for joining me, and I hope you all have a great trading week. I will see you next week, Tuesday, for another market outlook. Goodbye.